Hey, this is Brett Hickey with Compass Real Estate. I just wanted to give you a quick update on the Nashville real estate market. This is going to be on single family homes in the Nashville market. Um, there's always a lot of talk about what's happening with the real estate market. Is the market good? Is it slow? Is it bad? Is it this? Is it that? Neighbors and family, and you hear headlines and everything. So I just want to cut straight to it, show you real data, be very concise and to the point. That way you can have some takeaways of what's actually happening in the market. And if you are thinking of buying and selling in the next 1 to 3 months, if it's 6 to 12 months, if it's who knows, or if you just want to keep tabs on what's happening in the market because that's kind of a side passion of yours, fantastic. So here's what's going on is really here's some of my notes, and then but I'm going to go the right side is going to be some national numbers, and then I'm going to break it down and look and say, hey, is this trend true in Nashville? Right? Is that the same trend we're seeing in Nashville, or is it going to be different? So a couple points is, hey, are we in a new era of the housing market as we enter 2026? We'll see. And what I mean by new era is really our transactions starting to climb, which we are seeing. And are they getting to some of that pre-pandemic type levels, 2017, 2018, and 19 levels? We haven't seen 1 million home transactions across the country since 2017. Are we going to get there this year in 26? Possibly. Prices are about flat to down. So I'd call it flattish, just depending on the market. We'll see. Hey, is that actually happening in Nashville? What are prices in Nashville? Affordability is going to improve in this hypothetical new era of the housing market in 2026, and they're going to have some tailwinds as to why affordability is going to improve. And then incomes, we're projecting, or there's projections that incomes are going to increase faster than prices, which means increased affordability. So a few things, mortgage rates in post-pandemic eras. You can see here kind of this Q1 of 2023, Q4 of 24, and Q4 of this year. You have this median or this line at 6.2 of where we're at today. There's only been 3 times we've actually hit this in the past 3 years, and that actually coincides with. So let's see here, coincides with some increases in pricing. Now maybe that's just that year, right? So Q1 of 22 actually. Q1 of 22, we saw prices shoot up, right? And does that coincide with rates coming down? Well, when's the next big rate? I guess you had it here. The big rate fall, that was, call it September, October of 23. So we didn't see it as much in terms of pricing going up with demand going up. Maybe because the inventory is offsetting it. We did see it in Q3 or Q4 of 24. So coming here, October to November, that shoots up and then it kind of flattens here. So you see it a little bit, and then Q4 of this year, you're seeing kind of increase to flat pricing. So not I mean, it does increase demand. Pricing and demand is very sensitive to interest rates. Affordability, buyers out actually shopping are very sensitive to interest rates in real time. So let's see, weak employment helps rate fall. So weak employment, no one wants to see people lose their jobs, but just as a kind of a high level metric across the economy, we do need to see weaker employment numbers. That's just a fact. If we want to see some of the numbers come down from an interest rate, if we want to start to see some rate cuts, that would potentially impact the 10-year treasury, which then kind of trickles down to the 30-year fixed mortgage. So right here, I note that, hey, weak employment helps rates stay low or go lower. And let's see. So we're actually, it just came out today. So in the private market, ADP had, since the government was shut down, they had expected in September there was about a $40,000 increase in terms of jobs created in the private sector, and in October that was actually a negative 30. So there's 30,000 jobs that were lost in the private sector. What's interesting is companies that were 50 employees or less lost 120,000 jobs. Companies that were 50 employees or more, so kind of the midterm bigger companies, actually gained 90,000. So you still have a net negative of 30, but is it the kind of the rich getting richer type of thing? Is it the bigger kind of mid-sized companies that are continuing to grow, and it's the smaller companies that are losing jobs and not panning out? That's something to take a look at too. But data like that, since the government was shut down, get data like that from the ADP actually helps provide some insight for the Fed when they're making their decision later this month on, are they going to cut a rate? Are they going to cut it 25 bips? Are they going to cut it 50 bips? Are they going to cut it at all, right? So data like that is important. And they actually expected jobs to go up, and there was a net negative of 30,000. So that's something to take a look at. Mortgage rate spread. So 10-year treasury and 30-year fixed rate mortgage. Typically, that spread is at 170 basis points. So the 30-year fixed rate mortgage is going to be about 170 or 1.7% higher than the 10-year treasury on average. That's the historical norm. That typically will range, and a healthy number is 170 to 200, maybe 210. The nice thing is we were hovering 270 to 320 basis points spread, 2.7 to 3.2% difference between the 10-year and the 30-year. Well, now we're at 210. So today you have a 6.24 mortgage rate across the national average, and you have a 4.10 10-year treasury. That's a 214 or a 2.14% margin or spread between the two, and that's on the higher side of the historical average. So it's a much healthier number than 300 basis point spread that we were seeing in 2023 when you saw this massive increase in interest rates, where interest rates were shooting up to the 7-8%. Now we're at about 6.25. That spread is down, and that's because, hey, the election's over, so it's been over, right? But that was some of the uncertainty in that 23 when that spread was massive. Election uncertainty is over with, but you still do have geopolitical, you still have tariffs, you still have what's the Fed going to do? So you still have a ton of uncertainty in the market, but that's compressed down because you have a little bit more clarity of what's happening. But there's always going to be uncertainty, right? There's so many moving parts. That's just part of it. But that spread is condensed, and that is all that means is if you're looking to buy a home anytime in the near future, that is a good thing in terms of bringing that or compressing the 30-year fixed rate mortgage as low as we can get it. Fed rate cuts are never guaranteed. Yep. So coming here. Inventory. Okay, so this is where we're going to get into some national numbers. Inventory, 15.7% more year over year through November as opposed to 2024. So that's nationally. Let's take a look and see, okay, pricing. Let's go to inventory, active inventory, 5 years. We can actually just do it here. So inventory is up 13%. We're up 13%, and you can see increase here. So it looks like you're about 12 to 15% year over year, which is in line with the national numbers. So inventory is growing in Nashville at 13% on single family homes, and it's growing across the country at about 15-16%. Inventory expected, so these are expectations from Compass's national team, and they're expecting inventory to grow about 10% or so in 2016. So it looks like we're gonna see maybe a deceleration, not a decrease, but a deceleration of the increase or the appreciation in terms of inventory. Maybe the inventory won't go up as much, and I think partially is because we see a lot of homeowners that are locked into their home. And as rates come down, they are no longer going to be locked in, or maybe they just say, "Hey, it's time. We have a growing family. There's life circumstances. We can afford it. Incomes have gone up, et cetera, et cetera. It's time to sell." But then they also become a buyer, so that's a 1-for-1. That's increasing inventory, but it's also increasing demand. So maybe we won't see as much of an inventory increase because it's a 1-for-1, right? That remains to be seen. So inventory forecast through 2026. Once again, like I said, nationally, we could hit the $1 million or the 1 million home mark since 2017. We haven't been there since then. Right around here, 1 million. Are we projected there in 27? we'll see. They're going to be in 26, 27, TBD. Something that's encouraging for demand for buyers out there, and this is creates kind of a category I call shadow buyers or shadow demand, is purchase mortgage applications, 13-week rolling average. You can see the 2025 line just steadily increasing. So we've had rates kind of continuing to creep downward, and therefore purchase mortgage applications have just kind of been on the steady incline, right? So nothing drastic, but on steady incline, whereas you saw in 2022 drastically coming down after that spike in rates. You also saw in 23 creeping down, 24 kind of flat the whole way, and then 25 kind of on a steady incline. So that's encouraging in terms of demand. Let's see. I'm just looking at some of my notes, kind of this shadow demand. So by looking at purchase mortgage applications, you get this shadow demand, and you can see an increased amount of people that are looking for homes. And this is not necessarily tracked by transactions, because just because you've completed a purchase mortgage application, you are ready. You have a pre-qual letter, and maybe you're shopping, but that doesn't count as transactions. You're not being counted in any of that data, right? So it's this shadow demand that's kind of on the uptick in 2025 as we approach Q4 here, as we're in Q4 at the end of the year and coming into Q1 of 26. We're seeing more people with pre-quals and that are ready to buy. Are the houses out there, right? Are the houses out there? Are sellers becoming realistic enough, et cetera, et cetera? This is kind of that shadow demand that many people aren't talking about. How's that going to play out? We'll see. Weekly pending home sales. This is just saying, hey, since June 2025 has actually outpaced 2024 year over year on a month-to-month basis. Currently, we're at 8% year over year more pending sales. So let's see what that looks like. Pending sales. We're actually down. So Nashville's actually down. It's continued to go down, not much, right? November of 23, 24, kind of creeping down, a downward trend, but I'd say flat to down. But across the nation, you're actually seeing an 8% increase year over year from November of 24 to November of 25. I guess what this means is it shows momentum of home sales continuing to grow into 2026, right? Kind of flattish in Nashville, home sales, that's demand. This aligns with the drop in mortgage rates, more affordability. So kind of flattish. Could this number be more? Could it be 10% if the rates were higher? Yeah, absolutely. It could be. Could it be negative 15, 20%? Absolutely. If the rates were at 7%, 7.5%, yeah, I think that number would be there. So just because it's not positive doesn't mean that's a negative sign. And you can see here in Nashville, these are home sales, pending home sales, 25 versus 24. We're actually negative once again. So this correlates to this chart here. We're negative, so is Atlanta, New York, Charlotte, and Seattle. The rest are positive. So I think, once again, that could be negative 15, could be negative 10, 5. We're at 3. I think we're trending kind of flattish. As you can see here, we were trending up, 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 came up, and then maybe a little dip, but do we continue to trend back up to where we're blue in the near future in terms of demand and pending home sales? Days on market across the country, homes are taking about 15% longer. So they've gone from November, late November in 2024, it was about 71 days. Now it's about 81 and a half days in 2025. Does that correspond? What's happening in Nashville? Days on market, average days on market here, we're up 13%. So we're right in line, just under the national average. Nationally 15, Nashville up 13. So we've gone from 33 to 37. But that's still, look at 37 days compared to 81 and a half across the country. So, Nashville's moving, right? Let's not get it twisted. Nashville is still moving things. People are still buying and selling. It's in line with a percentage wise, but just in terms of overall days, 37 is not a lot, right? Let's go back and see. Let's just look at a timeline in terms of days on market. Days on market, sorry. Missed that for some reason. We'll go here 5 years. Let's just see November of 23, 11. 11. Oh, we're going to go look at average, sorry. So November of 23, we're at 25. We're at 37 today. 2 years ago, we were at 25. You go to November of 22. You go to November of 21. 11. I mean, just remember these days. 11 days was the average days on market in 2021. Now we're nearly, we're over tripling that, right? 300%, probably 3.25, 325% higher at 37 days. But that's still not a crazy amount if you look at nationally where we're at 81.5 days. So that just shows you Nashville's moving. Coming down, this is just talking about, hey, there's kind of a two-tiered market across the country. Nashville here at 88. And this is just, what is this? Average days on market, single family homes in contract. They're saying 88. We're showing 37. I'm not sure where they're pulling their data. We're looking right at it. This is, they might be on a, no, this is it, yeah. So I'm not sure exactly what they're looking for, but we're looking at Nashville. They might be looking at the overall kind of Nashville. National numbers always pull Murfreesboro, Nashville, kind of, everything within, say, 45 minutes around Nashville, which is not accurate. This number right here on this chart is going to be the city of Nashville at 37 days. But you can see it's increasing, right? And it's matching that number nationally. This is interesting. We're actually seeing more withdrawals this year. The red line being 23, and I saw an uptick, very late in the year. Whereas, and then 24 too, it's, kind of spoons up here. We're just seeing a much steadier increase here. So we're at 45%, whereas, the year before we were 35. So we're about 10 points higher. This, unfortunately, does not measure withdrawals locally here, but this is a trend we're seeing in Nashville. And, is this shadow inventory? Is this sellers who couldn't sell? They wanted to, but couldn't. And the question is, does inventory spike even more if these sellers come back to the market? Plus, we have new sellers. So new sellers that haven't even thought of it until today, right? Maybe, hey, for the first time around, we're going to list in Q1 of 26. But then you also have more inventory coming because you have the sellers who couldn't sell coming back to the market. Are we going to see twice the amount of homes coming to the market? Something to take a look at. Could lead to, excess inventory, which would then keep and suppress prices lower. And it would offset, an increase in demand if rates come lower. So that would be healthy for our market. How often are contracts falling out of contract? This is interesting. Let's see, nationally, there's more contracts. There's more cancellations than in 2024, but less than 2022 and 2023. So that's interesting as well. We're kind of sandwiched in between. So we are seeing cancellations, but not anything that should be of concern. Home price declines for the end of the year nationally. Hey, we're seeing, but it's looking like, kind of in line. 22 and 23 were kind of abnormal, I'd say. They flattened. They actually increased to flattened end of the year. 24 is kind of a normal year into the, seasonality, just cyclically. It tapers off, but we're seeing a much steeper decline in prices earlier in the year in 2025. So pending sales are about 1% above last year. If we can get a number here, I don't think we can, but potentially pending sales year over year. Let's see, pending sales right now are at 577,000. And if you look, November 577 to 584. So we're actually less than last year, which makes sense. We're tapering off. And then price per square foot. This is kind of interesting. Price per square foot never is apples to apples, but it's just an interesting metric as the asking price per square foot is nearly 2% less than 2024. Now, I don't think we're not going to be able to pull that in here. just on the local data, but this is interesting as that's continuing to go down. Um, and let's see, 2025 curve is dipping faster the second half of the year than it was in, than the yellow and the red lines, which is potentially a leading indicator for future sales prices. Our future sales, this is a leading indicator. Our these are in because these are asking price per square foot, so hence the leading indicator. But is this going to lead to future sales price decreases? Could it lead to, hey, home prices are down? Could it lead to that type of a headline in March of 2026? Is that what we're going to see because of this data right here? Is it's showing us, hey, the asking price for single family homes across the country is down 2%. Is that going to lead to a home sale price, the average home sale price down 2%? Or maybe because this is the asking price is down 2% on a price per square foot, does that mean the actual closed price of homes across the country is going to be down even more, maybe 5%? And that's where you're reading that headline come March of 26. It's, hey, home prices are down and all looks bad, but it's because of some of the things we've talked about today. So once again, hey, is that old era 2021 to 25 where inventory was shrinking, prices shot up because supply was down and affordability was down, so less demand, supply up, demand down. That means prices drive up. But are we coming into this new era, entering in 2026, where inventory's up or supply is up, and the demand is up as well, but is inventory kind of offsetting that as well? So where the increased supply outweighs the increased demand, meaning we get a little bit of compression in prices start to either stay flat or come down a bit. And we're not talking huge. We're not going to see a tanking market or a crashing market. So any headlines that read that, the data just doesn't show that, both from a current number standpoint and leading indicators. So that's all baloney if you hear that. But is that I think we're going to see increased supply outweigh increased demand, which will then bring a little bit of compression and flattening of home pricing. Now, this is interesting too. So price cuts imply continued weakness in pricing. So this is nationally. We're currently at 41% of homes across the country are seeing price cuts. That's interesting. This is going to align with the average sale. This is this is just abnormal, but you're seeing here, right? You're at 95%, 94%. So 94% of average sales price to list price. That means you are most likely seeing price cuts. It's not a one-to-one. They don't have that metric in here. But you're seeing 41% of homes. I mean, and this trend is true. If you look on Zillow, right, you're just scrolling Zillow at midnight because you can't sleep. You're going to see price cut, price cut, price cut, price cut. If you're actually looking at the price history, pretty common now because sellers they're still wanting the max dollar amount, and whether it's unrealistic or not, and depending on their strategy, that's up for a whole entirely different debate. But you're seeing that, I mean, that trend holds true. If you just get on Zillow right now, 41% of homes, or 4 out of every 10, right, are going to see a price cut. And that corresponds also with sellers giving more concessions and all these different things where it brings leverage into the buyer sandbox, which is nice. And one nice thing here is, speaking of leverage in the buyer sandbox, month of supply is actually, last year was 5.5. This year it's at 6.5. And why is that important from a data standpoint? Is because when that 6 month of supply, so that means that, hey, if no other houses were listed on the market in Nashville, it would take 6.5 months to sell all of the current inventory at the rate at which homes are selling. So the 6 month metric determines whether we are technically in a buyer or a seller market. So when we're above 6, which we haven't been at in a very, very long time. So let's just look. When's the last time we've been there? Over 5 years. I don't think we've been over. Yeah, we haven't been over. Oh, we hit 6. We hit 6 in January, and then we peaked back down. So look at, I mean, it would have taken a month back in June of 21. It would have taken a month here even less. Yeah, 1.17. They're taking a month to sell everything in March 21 through 22. And obviously we're back up here. We're at 6.5. So we're technically in a buyer's market, and you're seeing that as a buyer, you're going to have more leverage, whether you're seeing price cuts, you're seeing days on markets accumulate, you are getting more concessions, you're getting buyers offering to pay or sellers offering to pay closing costs and all of these things. And a lot of buyers, if you're strategic and you're smart, you're looking at homes that have been listed for 100 days plus. And not to say that maybe there is something wrong with the home, but maybe theirs were priced incorrectly. Maybe the photos weren't the greatest. Go see that home that's been listed for 119 days, and it's, they've cut the price 3 times, and it kind of caught your attention at first, but the pictures don't show the greatest, but it's kind of in a neighborhood you like. Go take a look at that house, and hey, if you like it, happened with the home I purchased. Um, but if you like the home, guess what? You have all the leverage. They've cut the price 3 times. They've been on the market 4 months. They haven't had showings in 2 months. The seller wants to sell, needs to sell. They're getting frustrated. Come in with some leverage, and I think you'd be surprised at what you can get at the end of the day and how that can improve your affordability situation. So hopefully that helps in terms of, hey, pairing national numbers, what's actually happening in Nashville. Real quickly, I'll go over this. So one thing to keep in mind with Nashville, in year-over-year numbers, November of 24 to November of 25, new listings are down 24%, but total inventory is up 13%. So what does that tell me? It says that, hey, less new listings are coming to the market, but a lot of stale listings are just sitting, right? They're just accumulating. So total inventory, even though less new homes are coming to the market, total inventory is increasing because the good homes are selling quickly, and they're coming off the market. But the old homes that are overpriced, that are not in good location, that are not properly merchandised and staged, and they're not in good condition, those are continuing to accumulate, and you see that with these two numbers. The total inventory increasing. Closings, I would say, are kind of a lagging data indicator. So demand on actual closed homes down 5%. I would say pending's a little bit of more current, because those are homes that are actually under contract. That's down 3%. So I'd say flat to down in terms of demand, with inventory increasing. And I think that's why you get this. You get the median sales price down, call it flat to down 1%. So inventory increasing, demand coming down, and that's keeping prices flat. In this case, down 6,000 year over year. Days on market, we've covered that. That's in line with the national numbers, increasing 13% year over year. And let's see, month supply. So 6.5. The fact we've passed that 6 threshold, 6 months of supply, means that we're now officially in a buyer's market here in Nashville for single family homes. You have the leverage, whether it's new, if it's a new listing, you still may have competition, right? But I would challenge you to, if you're seriously looking for a home, I would challenge you to go back and filter from Z to A, right? Filter from the last or the longest days on market for homes within your search, and start to say, hey, is the home sitting just because maybe they didn't properly market and merchandise and take pictures and prepare the home? Is it in a good area? Is it in a good location, a neighborhood that you are keen on? Go take a look at it. Go see it in person. And you don't know. Maybe that could be the home, and people are just sleeping on it, or they've seen it, and they just kind of overlook it, right? Be the smart, savvy buyer. Start looking at those homes and see if maybe there's a fit. Maybe there's not, but there could be. Happened to me. So there could be. That's just some savvy advice in this market, especially here in Q4 as we head into Q1 before demand and all of the action starts to pick up in spring. So hopefully this helps. Let me know if you have any questions, comments, add that. But hope to hear from you soon, and take care.